Good morning, everyone. Welcome to Adbond Real Estate Insights. My name is Joy Adebayo, and I'll be your facilitator for today's topics, which says Assets and Liabilities. We start with an opening quote from Robert Kiyosaki, which says, "Your house is not an asset, it's a liability." When you have a house that is not giving you an annual income or a rental income, it becomes a liability to you due to the maintenance you'll be doing, the NEPA bill, and every other thing that will be taking out money from you to maintain the house. So it becomes a liability to you. Next, we go to the definition of liability. First, assets are resources with economic values that an individual, corporation, or country owns or control with the expectation that it will provide a future benefit. And the next one is liabilities. These are debts a person or company owes, usually a sum of money. So going now we see the difference between assets, which always have economic value, and liabilities, which are debts, as we all know. And here we are going to have classifications of assets and liabilities. Classifications of assets here, we have 6 of them, which the first one is fixed asset, current asset, liquid asset, wasting asset, intangible asset, and fictitious assets. And under classification of liabilities, we have 4 of them, which the first one is long-term liabilities, fixed liabilities, current liabilities, and contingent liabilities. So we go further explaining each of the assets. The first one here under classification of assets is the fixed asset. These are assets which are not to be sold by the firm or an individual, as the case may be, and to be used for a long period of time. Such type of asset are known as long-term assets. Examples of these are land, buildings, plants and machinery, vehicles, equipment, patent, trademark, and so on and so forth. The second one is current assets. Current assets are those assets which can be converted into cash easily from the market, generally within a year. For example, cash in hand, cash at bank, trade receivables, inventory, and so on. So we can always see current as cash at the bank as current asset. When you have money in your pocket, those are also current assets. The next one is liquid asset. Liquid assets are those which are already in the form of cash or can easily be convertible into cash and has a negligible effect on the price available in the market. Examples of these are marketable securities, government bonds, certificates of deposit, and so on. So these are readily acceptable in the market. They are liquid assets. The next one here is wasting assets. Wasting assets are the assets that have a useful life and we can use it to depreciate with the time, and after some time or years, it becomes useless. For example, natural gas, such as natural resources, such as gas, timber, coal. The value of this asset goes down as we take out the content, and when we take out this completely, it will become useless. We use the example of our cooking gas. When you have your cylinder, fill it with gas, and you keep cooking for a while, after a number of days or weeks, it's finished. That makes the cylinder useless because you can't use it anymore. Also, coal, our cooking charcoal, when you burn it after a while, it becomes ashes and it becomes useless to us. So those are wasting assets. And we have intangible assets. These are assets which cannot be seen or touched. Write in paper about them. These are not necessarily used. For example, goodwill, patent, and copyright, and so on. So when we say goodwill, let's assume a company has been in existence for 10 years, 100 years, and already has a goodwill, a good name. those kind of names, when you want to trade it, they become an asset, which it will go for a large sum of money. So those are intangible assets. And in the sixth one here is fictitious assets. These are valueless but are shown in the financial statements or the expenses which are treated as assets and are also known as fictitious assets. Examples of these are preliminary expenses. We can also give an example of a court case. The expenses incurred when such is happening. Examples of this type of. We go on to look at classification, and we have 4 of them listed here. The first one is long-term liabilities, which exist for 1 or more than a year. So, for example, the long time, a loan from the bank, a mortgage that can go for more than a year, 2 years, a house mortgage, and so on. Those are kind of long-term liabilities. So when you keep servicing such loans or mortgage, they are long-term liabilities. And the next one here, we have fixed liabilities. Liabilities which are paid at the time of termination of the business are known as fixed liability. Let's assume you have a contract of a business with someone. By the time you finish paying such money, they become a fixed liability because it has a time span, a duration of when it will end. And the next one here, we have current liabilities. Current liability can also be known as short-term liability. For those which are settled within a year, they are not so long of a liability, so they come as current liability. And the fourth one here, which is last but not the least, is contingent liabilities, which are actually liability that can become the actual liability. Just like mention of the court case, those are examples of liability. When you don't win a court case or you win, they also incur as a liability to a company or to the individual that has spent such money to give as a professional service to the people that render the services. And we have our recommendations here. First, we look at the habits we have to practice. The first one is use your money to acquire assets and not liabilities. Manage risks instead of avoiding them. Live below your means. Don't try to copy other people's lifestyle and try to spend so much lavishly that you are living from one debt to the other. And the next one is work to learn, not to earn. You have to invest in yourself by book reading, by learning more trade, by going for trainings and the likes. So when you work to learn, before you know, you get recommendations from other people to earn more. So you must learn to work and not to earn. And the books which I'll recommend, the first one is Rich Dad Poor Dad by Robert Kiyosaki, and the next one is The Richest Man in Babylon by George Clason. So thank you. And our wisdom quote for today is, stick to a strict formula by which you make all your investments and you will do fine. When you have a formula that works best for you, when you are investing in different portfolios, then you have to be strict with it and stick to it so that you don't have to be juggling from one portfolio to the other and be making mistakes, thereby acquiring liabilities to yourself. So, thank you for joining us on today's Real Estate Insights with the Hardborn team. Stay with us next. If you have any comments, suggestions, kindly drop it in our comment section.